lessons from my first 30 years of value investing. So, at the end of 92 and 93, the first book I read on investing was One Up on Wall Street by Peter Lynch. And the second one was The Intelligent Investor by Ben Graham. But early 93, I received all the annual letters from Warren Buffett. I think I wrote to Omaha because that was before the internet, so I wrote a letter to Warren. And he sent me a big package of all the annual letters, I think from 1977 to 1992. I read that and then basically changed my life. So I decided that I wanted to invest in the stock market using Warren Buffett's approach. So I started to invest in 93, and after 5 years of having, good results, I thought I was ready to start my own firm. So in 1998, I started Giverny Capital. The name Giverny, for those that wonders, it comes from Claude Monet's house, where he had his garden and his water lilies. And I thought it is a very beautiful place, so I wanted to use that analogy. And the analogy is a portfolio is a little bit like a garden. So you want to cultivate great flowers, great trees, but the most important quality needed is patience, because it takes years to get great trees and great gardens. So today we have 3.8 billion of assets under management in Canadian dollars. We have an office in Canada, in Montreal, but also 2 offices in the US, one in Princeton, New Jersey, and the other in New York City. We are 100% owned by partners of the firm. And I have a 30-year track record. So I started to manage money in 1993 at the end of the second quarter, so July 1st. And so far, I've done about 15% per year on my own portfolio, which is a little bit more than 5% annual value added compared to the index. We'll go through the details here. You have all the years since 93, the results. These are in Canadian dollars. But you have the last column, it's the difference between the Canadian dollar and the US dollar over the years. And basically, the Canadian dollar today is about the same level as it was 30 years ago. So the currency changes didn't do much. We always invest about 80% of our assets in the US. So these are in Canadian dollar, but mostly it's US returns. So as you can see, we've done about 15% per year compared to 9.4% for our benchmark. And you have the same results in graph form. So $100,000 invested in 93 would be worth a little more than $7.6 million in Canadian dollar today, compared with 1.6 million for the benchmark we use. So I wanted to go a little bit about our philosophy, how we got there. And we have to realize that the investment management is relative to the average activity. You always compare yourself to an average, which is basically an index. So I call it relative investing should follow this curve, which is the bell curve that was invented by Gauss. And as you can see, and you probably know about this, most of the returns tend to be normalized to the middle. So in this case, the middle would be the benchmark. Many uses the S&P 500. We use a kind of hybrid benchmark where we do have the S&P 500, but also the Russell 2000. Since we invest in Canada, we have the TSX, the Toronto Stock Exchange index in our benchmark, and the MSCI EFI for the foreign companies. So the conventional approach to investing is basically you have this chart, but most managers tend to have much lower than the average return. Why is that? So the benchmark does probably better than 80 to 90% of money managers. So why is this? Well, it's basically there's one part of the reason is because many managers keep a little bit of cash on hand. They have fees, of course, and also they have what I call a crowd following approach. So basically, how not to beat the normal distribution in the stock market. Well, first, you want to invest with the same time horizon as other investors. So if you invest on a short period of time, I think you lower your return. So basically, I try to invert a little bit like Charlie Munger says, you have to invert always. And so I ask myself what not to do if I want to be the index. So also, you want to own a lot of companies so you don't differ too much from the averages. You don't want to be left out of the current fashion and fad trend, whatever is popular. So that's the part of the crowd following. Of course, if you believe that you're smarter than the others and you can predict the stock market, I think it can lower returns. And like I said, if you keep some cash, and most managers keep some cash, usually it will reduce your performance, because let's say if the stock market does 8 to 10% a year and you own some cash that yields 3 or 4%, you're right from the beginning you start behind. So you go to the same chart, you have the benchmark that does much better than most managers, and we are here. The Rochon portfolio, which I started in '93, so far, knock on wood, in the last 30 years, I've done a little better than the average. So what is needed is to beat the normal distribution. And of course, I've done well, but I want to keep doing well. So it's very important to ask yourself, what is needed if I want to continue to overperform? Well, I think the first thing, you have to be able to think differently from the others. And I think the first criteria for that is to look at stocks as businesses. When we purchase stocks, we really become owners of companies. We don't try to predict the stock market, so like I said, we really act like owner. We don't act like a speculator trying to predict the market. We also own a few carefully selected companies, and we want to be impervious to market fluctuations, to have a very long-term horizon. And that goes back to Ben Graham that says that one key reason that you can do better is to be impervious to the stock market fluctuation, and compared, as you know, the stock market to a manic depressive syndrome person. So you want to be able to live through the ups and downs. And perhaps one very important, and I'll go a little further into that, is to develop what I call the right behaviors. So rationality, humility, and patience. So first, in my art of investing, I was raised as an engineer, so I have a scientific education. I think there's some advantages to that. First, I think I can develop a rational mind. I understand numbers, and there's a lot of financial beliefs I don't need to unlearn. I'm always fascinated by all these CFAs that use Greek letters to sum up the stock market, and never really understood all that, but I didn't have to unlearn that. But there are disadvantages to a scientific education. First, you're trained to look at past numbers on the belief that the future will be similar. But humans and human society and human companies, they don't behave like atoms. The past is not a guarantee that the future will be the same. Also, one disadvantage of a scientific education, you're not trained to judge, but to gather facts. And I think one important part of being a good investor is to have good judgment. And you're trained to be precise and right, but investing is about being imprecise and accepting to be wrong as often as 30 or 40% of the time. So you have to accept that even if you do a lot of analysis, when you're investing, there's a lot of things you don't know about the future, and you have to accept that. So you have to be able to combine what I called the quantitative and the qualitative part of your brain. So the logical part of it, but also the creative part, the one that has a little bit of artistic in it, so you're able to judge and evaluate things, not necessarily based on formulas. So if I have to sum up what I try to build in my approach, is there's really kind of a a science part, a financial part, where I look at formulas and understand the businesses, but I want to learn about the history of the capitalist system, the history of the businesses, the history also of the management in the company. And finally, you want to add an artistic part. And the artistic part is really to have judgment and try to have a creative mind and see things a little different than the others. So the investment process, we basically have this very large watch list of companies all over the world. We try to look at everything that may interest us. So I've been following hundreds and hundreds of companies over the last years, and I have this list of companies I want to follow. We go to conferences, we talk to friends, and we do some screens with some software, and we get this group of companies that interest us. But very quickly, we remove a lot of them. First, we look at the return on capital. We don't want to own companies that don't make profits. We want companies that have a very good balance sheet. We want companies that we think have significant free cash flow, that have some kind of intrinsic thing in their business where they can earn high return on capital. Just with those criteria, we probably remove 95% of companies we look at. And then we want to really understand the nature of the business model, what kind of assets they have, barriers to entry, brand awareness, and we'll look at the management team. Are they owners? Are they in the same boat that we are? Have they created value for their shareholders over the long run? And finally, we try to value the businesses. So when a company fits all our criteria, we try to build a model over the next 5 years and to have a target where do we think the company will trade in 5 years. And if we can buy it at half what we think it's going to be worth in 5 years, it becomes a candidate for the portfolio. So if we're right, we would earn 15% per year over 5 years. A quotation I always use is one by John Templeton. It's one of, I didn't mention it at the beginning, but I read all the writings by John Templeton too, and he was a big influence on my approach. And he basically said that to obtain better results than the others, you must do something different from the others. What do we do different at Giverny Capital? I think it's not a question of IQ or work or all the things I mentioned to you about the approach and looking at numbers and competitive advantage. We're not alone. A lot of people do that. What we think we can different ourselves from other investors is really in our behavior. And there's 3 main qualities that I think are needed when you invest in the stock market. It's humility, rationality, and patience. So first, in terms of rationality, we focus on the fundamentals of the companies, not on the short-term stock price. In terms of rationality and humility also, we accept that we'll underperform the benchmark about 1 year out of 3. And that's been my experience so far. When we look at all the great money managers over time, even the best ones, they have underperformed, 1 year out of 3. So I think that's you have to accept that's part of the investment business of owning companies. You'll underperform from time to time. And in terms of humility also, we don't try to time the stock market. We expect to be fully invested in most environment, and we believe that stocks will do better than any other asset class over time. In terms of humility and rationality, again, we accept that we have a circle of competence, companies that we can understand, and we stay within that circle. We don't try to know everything about everything. In terms of humility, again, we recognize our mistakes when we make them and try to learn from them instead of denying them. And in terms of patience, of course, when you buy a stock, it can take years before you get rewarded. So you have to have a very long-term horizon, but also it means that when there's bear market, You have to stay the course so we don't panic during crisis, and we maintain a focus on the long-term objectives we have set of ourselves. So a few words about market correction. They're part of the equity investment game, really. So since I started in 93, so just in the last a little more than 30 years, there have been 15 correction of more than 10%, 8 correction of more than 15%, 5 correction of more than 20%, and 2 correction of more than 50%. So I've listed them here, and as you can see, I think there's a little pointer here. Okay. As you can see, if you don't count the last 2 ones, because it's not been 5 years yet, the correction on average were 30%, but 5 years later, the stock market was up 110% from the low. So if you didn't panic during those years, you did well. So it's very important not only to be a good investor, to be a good stock picker, but you have to also stay the course in tough times. In terms of humility, I always strive to improve the investment technique. I always study in depth my mistakes. Of course, we all make mistakes, but I think the key quality needed is to accept that we're human, we make mistakes, but we want to learn from them. So I force myself in our annual letter for the last more than 25 years, I always list my 3 best mistakes of the year. So I give them medals. So people find that funny, and it's a very popular part of the annual report. I don't know why, because it's very painful. But I think in the end, it's going to be helpful, because by forcing myself to give 3 medals per year, I look deeply into all the mistakes I've made and cherry pick the 3 best. And of course, I analyze why they were mistakes, and I hope I won't repeat them in the future. A few words about patience. People think that patience is the ability to wait, but it's not really that. It's the ability to keep a good attitude while you're waiting. And the good attitude is to focus on what's happening to the company, not the stock. So if a company has disappointing results and the stock goes down, it's not being patient to hold on to it. It's denying that the company has problems. So, but as long as the fundamentals of the company are intact, we'll stay shareholders and be patient. When do we sell? Well, basically we have 4 reasons we'll sell a security in the portfolio. The first reason, I think, should be obvious. We just made a mistake in our analysis, so when we realize we made a mistake, the time to sell is right now. It's a little bit different, but the second reason is when the business fundamentals of the company start to deteriorate. There's new developments, there's new competitors, there's new change in the environments of the businesses. If the analysis of what's happening today invalidate the original thesis of investment, we'll sell. The third reason is not that common, but it does happen, is when the stock gets overvalued, when we believe the stock has gone up a little bit of it ahead of itself. I think the rational thing is to sell, but you have to be very prudent, because sometimes I've made a mistake, that mistake many times. A stock can be a little ahead of itself, but in fact there's so many good news coming up in the next few quarters or years that the stock appears overvalued, but in fact it was not at all. So you have to be very careful, because you want to keep your winners. And but it does happen that sometimes the stock gets overvalued, and in those cases, even if you're prudent on it, I think the right thing to do is to sell. But the most common reason we'll sell a stock is really because there's a new opportunity. So when we find either a new security or a company we've been following for a while that becomes at a good price in the stock market, and we want to purchase shares, since we're always 100% invested, we have to sell something else. So we'll sell ABC just because we believe that XYZ is more attractive. So the 3 most important lessons I've learned over the last 30 years, the first one is never to try to predict the stock market. Always keep a long-term horizon. It's really to act like an authentic business owner.
The second one is the key is to own outstanding companies over many, many years. Yes, valuation is important, but it should not be the first criteria. The first criteria is to own outstanding businesses. And the third major lessons I learned is to develop and always strive to improve on the right behaviors. And those right behaviors, in my opinion, are rationality, humility, and patience. So I want to take a few examples. I wanted to start with Constellation Software, which is our top holding in the portfolio. We invested the first time in January 2014, so more than 10 years ago. Of course, I'm a little biased because it's done very well, but it's also a Canadian company, and so it's probably one of the best businesses in Canada. And as you can see, we purchased the stock at about $250 10 years ago, and it's about $3,500 today. And if you look at their earnings since we purchased it, in 2014, they earned $17 per share, and last year they owned a little bit more than $86 per share. So they compounded the earnings per share at 19% per year. So it's been a very good performance from the company. And as you can see, earnings went up every year. And one thing I really like about Constellation is his CEO, Mark Leonard. I think he's an outstanding CEO, a very, very humble person. I've met him a couple of times. And the first time I met him, you know, I thought we should buy more. I thought it was a great company. When I really met him in person, I think he's one of the best CEO I've ever met. So the reasons we like Constellation, it's a great business, stable and recurring revenues. They consolidate the industry of software, but always niche companies in the software industry. So it's a very fragmented industry. There's many potential candidates for acquisition. They have a very solid balance sheet, very low debt level. Like I said, the CEO is very owner-oriented. I mean, he doesn't have a pay. He's not paid to manage the company, so he's a big shareholder. And when we first purchased it 10 years ago, the stock was undervalued, was trading at 15 times earning. Sadly, today the stock has a much higher P ratio in the 30s now, but we always on the lookout. If there's a correction, we could decide to buy more. I just want to point out one phrase. When I first read the annual report of Constellation, well, it was early 2014, so it was a 2013 annual report. And I really like this phrase. He said that ideally, he'd like Constellation Software stock price to appreciate in tandem with the fundamental economics of the business. So you don't really read that in all the annual letters or when you meet CEOs. They always think their stock is undervalued. But he doesn't say that. He says that he likes it when the stock just reflects the intrinsic value of the business. The second stock I want to say a few words about is a more recent purchase. It's Fiserv. We purchased it, I think was last year. So we paid probably like $100, a little more than $100. And it's a company I've been following for many, many, many years. And if you look at the past 10 years in terms of earnings per share, they've grown earnings almost every year. The only down year was in 2018, wasn't that much. But if you look at the last 10 years, they've grown earnings per share by about 15% annually. I don't know if you know Fiserv. It's a company that processes transaction and payments for merchants and banks. And in fact, it's very interesting because the CEO is Frank Bisignano, and he was the CEO of First Data that was acquired in 2019 by Fiserv. And about 25 years before, so in 1998, I invested in First Data. So I knew First Data very well. First Data was privatized at some point, came back to the market, had lots of debt, but Mr. Bisignano did a very good job of improving things at First Data, and Fiserv acquired it, and the acquiree, First Data, the CEO acquired, became the CEO of Fiserv. So I thought that was a very, very strong vote of confidence for Mr. Bisignana. And Fiserv is a great business. It's stable and recurring revenues. They get their little fees on transaction and process. They have contract with banks to help them with their business. You probably know about the little terminal called Clover. It helps transaction for small merchants. And if you go to small restaurants and all that, not all of them, but many of them use Clover. I usually leave a higher tip when there's a Clover machine. So it's a very strong business, and it's very shielded from inflation. I remember one of the first books I read was The Money Masters, and in that book, he had by Adam Smith. Sir Adam Smith, yeah. And he had a profile on Warren Buffett, and Warren Buffett was interviewed for that book in 1980, so it was not well known at that time. And he said a phrase that really resonates with me. He said that the best business you want to own is a company that gets a royalty on the growth of others. And I think Fiserv is a little bit like Visa. It's a business like that. They get a royalty on a transaction of millions and millions of consumers and merchants and banks. So I think it's a very hard to displace company, and I can tell you that many young fintech companies have tried, and the stock is undervalued. When we first purchased it last year, we paid 15 times earnings. And even today, if you look at the chart here, it's the P ratio of Fiserv in the last 10 years. It still trades at 17 times this year's earning. So we think it's a fantastic company, good fundamentals, great CEO, and the valuation is very reasonable. So final words. I've read that many years ago. It basically says about the job of being a portfolio manager. It's really the first 30 years of stock investing that are the toughest. And after that, you're used to it. And so let's meet again in 2054. In the next 30 years, I'll be only 85 years old. And we'll talk about the lessons from the following 30 years of value investing. So like we say in French, it's a rendezvous.
Thank you.
I don't know if we have time for questions. Yeah, okay.
Thank you very much. Very thoughtful presentation.
A pleasure.
Two questions, please. The first one, what are your thoughts on concentration in your portfolio? And secondly, once one of your high-quality companies gets into the mid-30s PE and taking into account margin of safety, how comfortable are you then that they can still achieve in the years to come, or at least the next 5 to 6 years, that 15% growth, because that margin of safety comes down with the valuation at that level, I think.
Yes, yes. Well, the first question, how concentrated are we? I would say that probably our top 10, it depends, but it's between 50 and 60% of the portfolio. So it's pretty concentrated. We do have some small weight, so we like to know the company before we get to a bigger weight. So we usually start with a 1% weight, and as we get more comfortable, we'll increase the weight. So we probably have 5 to 10 companies that are a smaller weight, just in the process of getting to know them better. So we are concentrated in the top 10, but we do have 25 to 30 names in the portfolio. And as for the second question, of course, as the stock gets pricier, the margin of safety goes down. I've learned it in a very painful way that when you found a great company, if you make, let's say, 1,000% over 10 years, it's so important for the portfolio, for your performance. I would say that over 10, 15, 20 years, 2 or 3 or 4 names will make all the difference. So you want to keep your winners, and that means you want to keep them even if the stock price looks a little high in terms of P ratio. So I've made that mistake so many times of selling a stock that looked overvalued. Now I'm a little more, how could I say, I live with a compromise. finding this great company, and even if the stock looks a little pricey. When I purchase it, I want a margin of safety, but once I own it, and I've been owning it for a while, I'll live through perhaps a higher P than I would have 10 or 15 or 20 years ago. The only thing we do is once it gets to the 10% level in the portfolio, we'll trim it. We don't want to have a company that is more than 10% of the portfolio. That's probably one way we'll manage the fact that the stock gets a little pricey. I don't know if it answers well your question.
Thank you. Thank you for the presentation. Your annual stock fund performance certainly does leave an impression. Congratulations on that.
Thank you.
Following on a bit from that question, for those of you who've got access to FactSet, they have this neat little tool called holiday analysis. And it takes your portfolio at the 1st of January and just pretends you go away for a year and leave it alone. So given what you were saying about your positioning and the ability to, once you've bought a stock, potentially capture extra returns on the journey, have you got a feeling, or do you know the numbers in terms of your attribution as to what you owned and how much money you made through trading what you owned, but the opportunities you get on the journey?
Yeah, I don't go into details. I have one person that works with me that does a lot of that for me, and it's always very painful to see the results. Basically, it depends but the last few years, it seems that the more we trade, the lower the returns we get. That's just the funny thing about you want to improve things by, selling something that looks a little expensive and perhaps increasing a stock that is more attractive in terms of valuation. I wouldn't say in the last few years, that's not been a very rewarding strategy. I think the best approach is, to find 20, 25 companies and to own them many, many, many years. And it takes a few years to really get sometimes a reward. But I think as I get older and more experienced, I've reduced my turnover ratio. So I'll probably try to do less and less trades because very rarely it's very helpful. I think the best trades is to sell companies that have some fundamental problems and not to get, I always say that phrase that when you're whole, the worst thing you can do is continue to dig. So when a company has some problems, the quicker you sell, usually the better you'll be. So you have to, basically, I think it was 90 years ago, almost 100 years ago, Philip Carré wrote a book called The Art of Speculation, I think. It was published in 1930. So it's a very old book, very hard to find. And he had these rules of acquisition. And one rule was be quick to take your losses and reluctant to take your profits. And I think that's the best rule I've read in the last 90 years of finding books on investing. It sums up a lot of wisdom into how you should manage your portfolio. Does it answer your question well?
Yeah, and actually what you just said reminds me of a fund manager I worked with who was hugely successful, who had analysts working for him, and he used to say that when he had one of those situations, if the analyst came and said, I wouldn't sell it here, that was the time to immediately put the sell order on.
You're very diligent about your mistakes. So my question is, have you found a pattern in your mistakes, and what are those? And the second thing is, have you ever done the math what would have happened to your portfolio if you wouldn't have cut the 10% positions? Probably you would have compounded even higher. So that's my guess.
Yeah, well, if you look at all the methods of mistake, most of them, it's always the same. So I should learn. I don't learn quickly, but I should learn. It's usually that I found a great company and my only reluctance was the high P ratio. So basically, if you do find a great company that have great fundamentals, a great manager, and the P ratio looks a little high, perhaps you should buy it anyway. So that's the lesson of many mistakes. Still have some problem to it because, you know, I've been rereading Ben Graham and he talks about margin of safety all the time. So I guess you have to find the right balance between having a margin of safety and being ready to pay a higher P than ideally you'd like to. But life is not ideal. So if I had to make one compromise, it's probably on valuation. I think you have to own great businesses. That's the most important thing. I don't compromise on that. Probably valuation, I'm a little more flexible than used to be. And the second question about the weight. Yes, there's many companies I've trimmed over the years. I'm thinking Visa, I'm thinking Dollarama, O'Reilly Auto Parts. And the reasons I trimmed them, it was not necessarily because they had reached 10%, but I believe the valuation was a little high, and they were all mistakes. So that's why I said reluctant to sell.
Yes, hello, good morning. Thank you for sharing your experience with us over so many years. Yeah, I'm here at the back.
Okay. You're behind a column, but I hear you.
Yeah, the columnist is speaking. But I have two questions, please. The first one is, given all your years of experience in the business, what would come down about what are the main indicators you look for a company? I mean, do you pay attention only to return on investment capital, gross margin, so forth and so on? What would be your 5 bullets or you find indicators about a good business? And the other one is, could you dump a good business due to a high valuation, or given that you grow up, you no longer pay attention to valuation per se?
Well, first, I think it's important to look at valuation because if you're not too disciplined on that, you can pay 30 times, 40 times, 50 times. You always can justify high valuation if you don't want to be disciplined about it. So you have to find the right balance of having a margin of safety and be a little more compromised on valuation. In terms of great businesses, in the capitalist world, businesses, the environment, the competitive environment always changes so fast. It's hard to find a company that will stay great for many years, even decades. I've come to learn that the most important criteria, yes, you need a great business, but you always need a great CEO, a great manager. And I didn't talk about it in the presentation, but another writer that really influenced me was Philip Fisher. I met him 25 years ago. He passed away, I think, in the early 2000s. But if you read all his books, the best one being Common Stocks and Uncommon Profits, he emphasizes a lot on management. And if you read one of his last interview, I think it was on Forbes, probably in the late 1990s, he answered a question to the journalist that asked him what was the most important lesson we've learned over 60 years of managing money. And he said that all his career he emphasized the quality of management, but he has not emphasized it enough. I think that's the most important criteria. And if you look at the two examples I gave you, Fiserv and Constellation, the main thing I like about them is their CEO. I mean, in the end, when you buy shares, what you're really doing is you become a partner with the CEO. If you don't want to be partner with him, there's no reason to buy shares. And that's probably the most important lesson. I know that Warren Buffett said that it's important to find a great horse and a great jockey. And if you have a great jockey and not a good horse, you won't win any races. But I would say that first you want a good horse, a great business, but you also need a great jockey. And a great CEO will do a lot of difference. And all those companies that have done so well over many, many years, like I talked about O'Reilly and Visa and Dollarama, they had great CEOs. And so, and it's hard to judge a CEO because you can look at numbers and how he's paid and all the acquisition they've made. But at the end of the day, you're really trying to judge a human being. And it's not something that can put into numbers. And I don't know if you know Tom Gaynor at Markel. He's a great CEO. And every time I meet him, I have this phrase in my head. This is the kind of man I would want my daughter to marry. And I think when you meet a CEO, that's the thing I'm trying to ask myself. Would I like this man to marry my daughter, or a woman to marry my son? So you want great people, and in the end, that will make all the difference in the world.
Thank you very much.